Everyone is chasing the next Nvidia. But what if there was an undervalued stock hiding in plain sight? A company that already serves 150 million users, spans over 70 countries, just flipped into cash flow mode, and guys, guess what? It's selling near all-time highs, and I think it has room to run. So in just a few short years, Nvidia went from a niche graphics chip maker to the king of AI. They were fueled by demand for GPUs and AI, gaming and data center, and its market cap soared past $3 trillion in 2024, and recently soared past $4 trillion. Guys, it wasn't all hype. A lot of it was numbers. Their revenue profit absolutely exploded. Their margins went crazy, and Nvidia became the backbone of the AI revolution. Investors who got in early didn't just make money. They saw life-changing returns. Now, the question is, one, did they see that happening? And two, what's the next one that's going to happen? There's something thrilling about finding the next breakout stock. It's the idea that you see what others don't, that you're early before the crowd catches on. But guys, guess what? With Nvidia, I think I heard about one person who wrote an article 5 or 6 years ago saying Nvidia is going to be on the forefront of AI when AI finally takes off. One person. Guys, if you were right in Nvidia, were you right for the right reasons? Or did you do what smart investors do? They found a great company at what seemed to be expensive price, bought into it, and it happened to explode. That's probably what happened, and more power to you. Now, this company we're going to talk about today, I think could be similar. Guys, the truth is this though. Real winners rarely look obvious as to what they're actually going to win on. They're often controversial, misunderstood, or written off by Wall Street until they're not. And we're going to show you a company today that checks these boxes. That company, Uber. So let's rewind quick. Uber IPO'd in 2019 as one of the most hyped up tech companies of the decade. But under the surface, it was messy. Years of negative cash flow, chaotic management, constant regulatory heat. The stock tumbled, never really gaining much traction. But behind the scenes, things were changing. The current CEO, Dara, not going to work here anymore. In 2021 or so, he said, listen, the market doesn't care about growth as much as it used to. It cares about cash flow. And he focused on generating cash flow and laying the foundation for a real business. And today, Uber is no longer just a ride-hailing app. It's a multi-pronged platform. Rides, food, delivery, freight, logistics, advertising, and soon, fintech and automation. It operates in over 70 countries, serves 150 million monthly users, yet the stock still hasn't priced like a tech platform. The disconnect, that's where opportunity lives. In early 2024, Bill Ackman, founder of Pershing Square, took a $2.2 billion position in Uber. That's not a trade. It's his largest holding. Ackman runs a concentrated portfolio of 10 or fewer stocks. When he bets big. And here's what he said. Uber is one of the best managed and highest quality businesses in the world, and can it still be purchased at a massive discount to its intrinsic value? He was an early investor through a venture fund, but he waited to go big until Uber proved it could scale profitably. Now it has, and Ackman isn't just chasing a story. He's betting big on it. Global scale, durable moat, and for those who don't know what a moat is, it's the way like a moat protects a castle. Uber's the castle, and it's protected. There's competition out there, but when you go in the US and say you want a cab or you want something, what do you say? Let's Uber there. It's become a verb. It's expanding its margin, and this is Uber's second act, and it looks nothing like its IPO days. Now, let's stop guessing and start analyzing. Let's pull up these metrics here. This is a $200 billion company, Mo. Mo, do you remember the first time you used Uber?
I do. It was a long time ago. But
when was it?
2012 or 13.
That was mine too.
Yeah.
Mine was 12. Mikey got it for me.
Oh, really?
We were in Chicago meeting with the Merrill guys, and I think I had to go to like a Bulls game.
Yeah.
And so he calls me this Uber, but back then it was only like high-end vehicles.
Right.
It was only like high-end, like luxury vehicles.
You know why I loved it? Because you didn't have to like negotiate cash pricing.
And
it was so annoying to.
And back then you didn't have to tip.
Right.
I still like tipping. Don't get me wrong.
Yeah.
But part of the appeal was that.
Yeah.
And
you just paid the price, deducted it from your card, and you move on. You don't
whether
have to talk
they
to
take a
anybody.
long time or not.
Yes. It was awesome.
It was perfect. That's the first time I used it. And I remember making fun of my brother for it. But Mo, look at this. In our community, 28 people have voted. The average rating is a buy.
Interesting.
No dividend, of course, but here's the great part. Look at this. 5-year average free cash flow, $1.9 billion. Last year, $7.8 billion in free cash flow.
It's a lot.
Mo.
Cash flow matters now.
Cash flow matters. The revenue is of $45 billion. They generated $7.8 billion in free cash flow.
That's a lot.
That's a lot of money. Look at their growth rate. 28% a year for the last 5 years, 28% a year for the last 3 years. Gross margin of 40%.
This is not the company it was 5, 6, 7 years ago.
It is not.
It was a disaster.
A lot of
back then.
potential here. So let's check out the 8 pillars here. Cluster F.
Yes.
3 checks, 5 X's. Guys, in a growth story like this, a company that has a history of having bad numbers, look at this. The 5-year price of free cash flow is 102. This PE ratio is absurd. I'm not even going to mention 20,000.
20,000.
But look at the cash flow. It's 5x'd.
Yeah.
So you have to look at this and go, the current free cash flow is 24. 24 with a company that has a massive moat and still has growth potential. So that's the fundamentals here, of course. What do the charts say, Mo? Where we don't care about the fundamentals at all.
Right, so this is interesting because this top yellow line, I put this here not to show a consolidation channel, but to show like this is a very strong level of support here. It has gotten to these all-time highs recently. It's really close now. It was all-time high about 97, so it's pretty close to there. I do think if it can hold this support level, it can really go. Now, if it breaks down, it's not going to go any lower than 80. So I think you're pretty safe here saying, okay, this is not going to go any lower than 80 if I'm going to take a position. And if you short it under 90, you can run it to 80. It's going to go back up. It's a really good looking chart.
Is it?
Yeah. This is
And obviously, it's not that it can't go below 80.
No,
just take
it can. It'll just take volume,
a lot of volume.
selling volume.
Yeah,
A lot of negativity on the stock.
correct. So before we get to analyst estimates and our stock analyzer tool, remember what stock analyzer tool does. It allows us to put the story and the numbers together based on the fundamentals to figure out the right price to buy for Uber. That's so important. It's a reason why it's used by over 1 million people per year. But before we get there, let's go check out the story and the financials. Mo, so look at this. In 2016, 3.85 billion, 8 billion, 10.5, 13, dropping 2020, obviously because of COVID.
Yep.
17.5, 32, 37, $44 billion.
Sheesh.
Look at this growth in revenue, guys.
It's huge.
It is ginormous. What about profit?
Damn.
Loss, gain, loss, gain.
Big gain.
Big gain, almost $10 billion last year, $12.3 billion in the last 12 months. So big losses to make up here, but they're on their way right now. Now, one thing I want to show you, Mo,
yeah.
look at their shares outstanding. Guys,
Right.
when a company has losses, there's only 2 ways to fund it. You either borrow money or you bring on investors. And the way you bring on investors is you sell shares. The problem with selling shares is it dilutes other people who've been along for the ride. They had call it in 2017, 1.09 billion investors, shares outstanding. They now have 2 billion, but they're holding steady.
So it's getting better, right? The
Way
dilution
better.
is becoming way less.
Way less, but it's still something to consider, especially in fast-growing companies. But Uber's generating cash flow, so they don't have to rely on issuing shares to get money out there. And the other thing is, if the stock is cheap, issuing shares is a terrible idea. So hopefully the company knows that. On the flip side, if the stock's expensive, buying back shares is a terrible idea. Now, let's go check out their cash flow statement. Now, guys, free cash flow is cash from operations less your capital expenditures. Capital expenditures are investments in the business to be able to grow the company. Now, a company like Uber is basically driven by software, so their capital expenditures aren't huge. A couple $100 million a year, not huge. So that means they can drive a lot of cash flow to the bottom line. So as they increase their cash from operations, look at these cash flow numbers, Mo.
Crazy.
-4.5, -2.5, -2, -5, -3.5, -1 billion, call it. Then cash flow. Guys, they were generating cash flow before the net income was catching up. And last year's free cash flow was 6.9 billion. And the last 12 months, it's been 7.8 billion. Guys, major changes in the company. I give their CEO major credit for pivoting from grow story to we're going to be a real business now. Now, guys, we had dissent within the company. Our in-house analyst, who I thought was going to definitely bring up commodities somehow having to do with Uber, but he did not. He actually contests that he doesn't know how long-term Uber really gets into all these different Uber Eats and things like that and makes a lot of money for the company. Mo, what's your response on that one? He makes a good point.
Yeah,
Just because something's good for consumers doesn't mean it's good for the business.
Right. It could be getting too widespread.
So remember, a lot of companies,
They try to do everything.
They try to do everything. And when they do that, it becomes their downfall.
Yeah.
Because the market wants growth.
Right.
This example I always give is Ann Arbor-based company, Borders Bookstore. Remember Borders?
Of course.
Remember hearing the story about Borders when they first started. I think it was two brothers started the company, I believe, and they had a plan for like exactly 217 stores. And the reason being, or some number like that, their comment was, we want to hit these specific metrics on a certain population. And there are 217 locations in the country that fit those metrics. And guys, they hit it out of the park. Their average receipt was like 10 times greater than the other bookstores out there. But then they went public, and it's all about grow. So they lowered their standards. And before you know it, the world of books changes. They go out of business, even though Barnes & Noble's still around, but not doing great.
Right.
It is a question to be seen. Like, is this growth into other markets going to be beneficial for Uber as a company? That will be seen.
I mean, I was very surprised when I logged on to the Uber app one time and saw that you could rent cars through there.
Can you?
Yeah. Like, I was like, really? Is this a good idea? I don't know.
I mean,
It's almost like they're pulling in like a Turo into it.
Of course, that's what it is.
Yeah.
But you look at things like Tesla.
Yeah.
You know-
Software company.
Well, that's what I was getting into. People said it's a software business, but they're not making any money from software.
Right.
In fact, their software has failed completely. From $12,000 for a car to $8,000 to $99 a month with a 3-month trial, and then 2% of people are buying it. It's like, okay, now you can look at the 10K and see more data on how the other stuff is going, but keep an eye on this. But a big margin business like this, Mo, generating $7.8 billion on $45 billion in revenue, that's a lot of money and growing. So it takes us to what really matters. What is the right price to pay for the company? So I'm going to pull up Uber when I did it in the past. Now, a couple of hard things about Uber here. Their history of profitability is very limited. Yeah. Last 5 years, they've made 6.3% average in free cash flow, but last year was 17%. They basically broke even in profit margin, but last year did 27%. So what's the right price to pay? Actually, you know what? We didn't do analyst estimates yet. Let's go back to that first. Because then you'll see, look at this EPS growth they have. 281 to 652, 49%, 28%, 30%, 39%. That's huge growth.
Yeah.
And look at their revenue growth. 15, 14, 11, 10. Big growth. So you might look at my assumptions about the future and say I'm being conservative because I did 5, 8, and 11% over the next 10 years. Okay? Profit margin. I got to change these, Mo. I did 10, 18, and 26. What do you think about that?
I mean,
we don't have a history to look at.
That's the thing. We don't know. I mean, I like the spread that you have.
We have to have a wide spread because we don't know the history. We don't know what's going on. I mean, here's the deal. If you have a 40% gross margin, how do you have 27% profit margin? Let me look at something here real quick. This is kind of confusing me. Let me go to the income statement. Is there any other income and expenses? $2 billion right there. Guys, $2 billion of their 12.3. So it's actually 10 billion, which makes their margin a little bit lower. Okay, so they had a one-time, you got to look at these things. I was looking at saying, how do you make 40% gross margin? Now, I want to break this down easy. 40% gross margin means for all their revenue, 40% of it went to their pockets to go pay then overhead costs and taxes. It was hard for me to say, how do you go from 40% gross margin to pay all your overhead, all your taxes, and net 27%? So I'm still going to change my profit numbers here, Mo, but what do you think about this? 12, 18, and 24. So I made the low higher, kept the middle the same, because I'm looking at the free cash flow 17%. Man, that should go higher too, though. I'm fine with this right now. We're basically trying to get to an idea of like what's a reasonable thing to look at.
But also, this shows how hard it is to do it based on a company that doesn't really have a track record of what we're looking for.
That is exactly it, Mo.
So that's why this is hard.
And the funny thing is, it's a $200 billion company.
I know. That's the crazy thing. This is almost like we're looking at a $200 million company.
But this is what makes it have so much potential. Because if they are able to increase their gross margin, are able to increase their profit, or grow incredibly, this is nuts for the company.
Right.
PE, I did 18, 22, and 26. Thoughts?
I mean, they're the leader in getting people around versus like a yellow cab.
And Lyft.
Which is almost, I don't know.
Name me the third one.
I don't know.
I don't even think there is a third one.
Is that it now?
Oh, Waymo probably is. And by the way,
but they don't have people driving.
So I think you bring up a good point about Waymo. Uber's doing their own self-driving, but Waymo's owned by Google. I was in Phoenix just, 3 months ago, and I was looking at it going, this is awesome. Like,
the cars are probably, it's not really a crapshoot of what car you're going to get into because it's controlled by Google.
can I say what I just did?
Yeah, say.
What I did when I was there?
What?
So a Waymo's coming, I'm driving my car. A Waymo's coming on the other side of the road, right?
You went at it.
I merged just a little bit. I veered into the lane to see what it did. Right there. I mean, that's an easy one for it but it's still like funny to look at it going like, I shouldn't have been. By the way, when I say that, I wasn't going in the other lane. I was like basically going on the yellow
Playing
line.
chicken with the Waymo.
But the point is, it's incredible. And Uber's working on their own version. The question is, who's going to win?
Yeah.
So guys, I put a PE of 18, 22, and 26, and my 9% desired return. The 9% desired return, I really want you to hear this. This is my intrinsic value return. It's the market return. This is not the return I want to buy an individual company. If I want to make 9 or 10%, I'm just going to buy a low-cost ETF and not deal with the hassles. I need a higher number than this, but I'm trying to figure out what the fair market value for the company is based on my assumptions. I want to explain to you guys my story for investing. Believe it or not, 20 years ago, guys, I was not an investor. I chased hot stocks. I chased tips. I chased all the hype. This is the late 90s, so actually 25 years ago. I was hoping something would stick. But I realized very quickly, soon thereafter, that that's not investing, that's gambling. Guys, I would have bought Uber based on the story and never looked at the numbers. I can't tell you any of the numbers of any of the companies I bought 25 or 30 years ago. That's why I created Everything Money. Something didn't make sense. I wish I had a channel like this because I know that if I'd heard this, I'd have been like, that makes sense to me. And hopefully, if you're new to the channel, you're hearing that right now. So when I'm looking at Everything Money, when you're watching the videos, when you're in our community, you're not just getting access to this powerful software. You're getting a foundation of learning. You're getting a foundation of investing. We integrate everybody in the community by watching our courses, watching our exclusive content. We want everyone in the same foundational way of thinking. We want to get you engaged in our community of like-minded investors who everyone wants to level up their investing game. No matter if you're beginner or advanced, we have the full gamut, the full range of people in there. Everyone's trying to level up no matter where you're at. Because even Munger and Buffett and Gates all read like crazy, even though they're some of the brilliant, most intelligent minds in the world, RIP Charlie Munger. And guys, what's even more exciting is we're adding brokerage access to our platform. This will allow people in the community to link their brokerage firm. They don't have to move any money around. They just link their brokerage firm into our platform and allows them to buy and sell stocks as they research them here on the software. As you see these prices that we're going to show you, you can sit there and determine if you're buying or selling or doing nothing. This is going to make it way easier than ever to have a community that can level up your game. This is the next chapter of Everything Money, and we want serious people to be part of it. Whether you're a new person just learning or you're an advanced investor. The big thing here, and I have to be very clear about this, we don't want people who are chasing the next shiny object. If you're not ready to follow a process, if you're not ready to stick with it, if you're not willing to put in the work, don't sign up. We don't want your money. We don't need your time. But if you're committed to investing the right way and getting better no matter where you are, start your 7-day trial today. Click the link below. We have limited spots each day. And guys, there's talk right now, and I've been talking about this for a while, about having an application to join the community. It's not about how much money you have. It's about your commitment to learning. It's not about how knowledgeable you are. It's your commitment to learning. So if you're serious, this is your moment. Click the link below, sign up. It's 7 days. It's so easy. I hit the analyze button. The stock's currently at 91.
What is it?
A low of 51, a high of 210, middle price of 110.
More green than I thought.
And I think I was being conservative above, especially on the revenue growth
An
side.
interesting play.
So that's why I look at this going, it has Nvidia type feel to it in the sense that what could be a catalyst to the next level. Yeah. Now, is it going to 10x in 1 year? I don't know. I doubt it. But I also don't think Nvidia should have 10x'd in a year and a half or whatever it did. So guys, if you want to understand, I talked about Ackman earlier. If you want to understand how he thinks and why he builds massive concentrated positions like this, click the video on your screen. We break down his entire strategy, how he builds conviction, and what he's doing to create the next Berkshire Hathaway. Because great investors don't chase headlines. They move before the headlines. Thank you for your time.